Welcome to the School of Postgraduate Studies, Master of Project Planning and Management. Our course unit today is Project Risk and Cost Management, and we are looking at Module 2, which is Budgetary Planning and Control. Let's first of all look at objectives of the module. And one is to study the meaning of a project budget. Two is to study summary of the budgeting process. Three, to study stages of budgeting, that is to say budget planning and budget controlling. And four, to study the functions of budget committee. What is a budget or a project budget? The project budget is a tool used by project managers to estimate the total cost of a project. It includes a detailed estimate of all costs that are expected to be incurred before the project is completed. Big projects budgets have a large number of costs, including labor costs, material procurement costs, and operating costs. The project budget itself is a dynamic document. It is constantly updated over the course of the project. A few things may change in the course of the project, and therefore the budget is not fixed. Sometimes there are a few divergence from the correct figure, and those variances are always explained why you don't spend 90% and you spent 91% as it was planned in the budget. Here is a summary of budgeting process in steps. And we have basically 10 steps in our study here, starting from 1 to determine timeline. How shall we actually schedule our budget in terms of time? We actually associate every cost at a given time. 2, we agree on our goals. What are we set to achieve in our project? That is our step number 2 in our budgeting process steps. 3, we have to understand current financial status. What do we have in our coffers? How much do we have as an organization? And how much do we need to get from elsewhere so that we can be able to run the project efficiently? Number 4, agree on budget approach. We should actually see whether we are following the vote system, how much is assigned to which kind of activity, and so on and so forth. 5, we have to develop draft expenses budget. What are we going to spend our money on? Those items that are going to make the project successful, but they actually consume money, are expenses. The running costs of the organization could be transport, it could be refreshments, field work, and all those monies that are paid to actually see that the activities of the project are implemented. 6, develop draft income budget. Where are our sources? How shall we be raising money? The money we have and also the money we shall be getting from the project activities. 7, review draft budget. Time and again, we look at it and see if there are any changes. Prices, sometimes they change, but our continuous research will always tell us if something has changed, we actually review the budget and get the correct current figures. Number 8, we approve the budget. If we have reviewed it, in number 7, number 8, we have to approve the budget so that the project can go on. Number 9, document budget decisions. Whatever we have decided that this is the amount set aside for salaries, this is for fuel, this is for office expenses, this is for refreshment. We have made a decision and we document them so that we don't actually deviate from whatever has been documented. 10, implement the budget. This is a summary of budgeting process steps. I've given you 10. You should be able to use the reference books that were given to you at the start of the course and actually read more about the 10 steps here given. So the stages of budgeting, we are going to look at budget planning and budget control in detail and in turn. What is budget planning? The budget process forces managers to consider carefully their goals and objectives and to specify means of achieving them. This is at the level of planning. We shall actually consider carefully our goals and objectives and specify means of achieving our goals. In budget control, the budgets provide a means of evaluating performance. Here, potential causes of significant deviations from budgets may include budgets could have been poorly conceived. Two, conditions have changed since the budget was prepared. Perhaps the prices have changed or the number of people that are involved in the project have increased or reduced. All these will actually be conditions that will have arisen so that there is the deviation from what was budgeted initially. Managers may have done a particularly good or poor job. If managers are efficient, the budget will actually not deviate from what was actually planned. But if the job is poor, it means we shall have unfavorable budget whereby we may not have sufficient funds. There will be a deficit in our budget. Let's look at how we can develop the budget. Developing the budget is done in the following ways. One, we have to have what we call the budget committee. We are going to explain them in turn and in detail in the next slides. Two, the budget time period. Is it a day? Is it a week, a month, and so on? Let's also look at zero-based budgeting. In the next slides, we're going to look at these three in detail and in turn. One, the budget committee. The budget committee is one which prepares the budget and is fully responsible for the implementation of our budgets. Moreover, the budget committee also exercises control. Any deviations, there is corrective measures that is always put in place so that the budget decisions are not changed. A budget officer is enough to coordinate the work of line managers to execute the budget in small business concern, okay? In case of large size business concern, if it's a big NGO or a large business concern, there is need of a budget committee that will sit and actually coordinate these activities. The chief executive of an organization, line manager, and the budget officer are the members of the budget committee, or as may be decided by the organization, but they should be people who are well conversant with costing in projects. Two, the budget time period. The budgets may cover a variety of time periods. It could be a day, it could be a week, a month, a quarter, it could be a year, or sometimes it's even longer. So our budgets match with the time. If it's a day, we calculate how much we take in a number of hours, and we have set that cost at that particular day. And if it is 7 days, then we shall multiply by 7. If it's a month, then also the cost should actually match a month. Let's look at functions of budget committee. The budget committee does the following functions. The general policies and objectives of an organization are decided in the budget committee. Two, the budget committee extends assistance to line managers for forecasting by supplying historical data. They will actually tell us initially this item has been costing this amount of money. Initially, there is always inflation of around this percentage. So in your past budgeting, we have to give a given allowance so that we don't actually get into deficit. Number three, the budget committee receives and reviews the individual budget estimates and different departments and visions. Number four, the budget committee also receives instructions from the chief executive and gives instructions to line managers. The chief executive, who is the boss of the organization, or the manager of the organization, will always give some instructions. And this committee will actually channel the very instructions to the line managers. Number five, the budget committee gives suggestions and modifications in budgets in accordance with organizational objectives. Number six, the budget committee approves the revised budgets. Once something has been revised, it cannot be implemented until the budget committee approves that kind of adjustment. Number seven, the budget committee receives and investigates accomplishments regarding practical implementation of budgets. Once something has been satisfactorily completed, this will be received by the budget committee. Number eight, it identifies responsibilities for poor performance and recommend corrective actions if necessary. If there is any poor performance, corrective measures are given by the budget committee. They can give good advice so that the errors are corrected. Number nine, the budget committee gives suggestions to improve efficiency and achieve budgetary goals. Okay, it gives guidelines, it gives suggestions, it actually protects the organization from going astray as far as expenditure is concerned. It keeps the project or the organization within line of what has been budgeted or planned before. Last but very important, the budget committee coordinates the budgetary control program of the organization. Let's look at zero-based budgeting. Zero-based budgeting is a method. All expenses must be justified for each new period. It starts from zero base, and every function within an organization is analyzed for its needs and costs. Budgets are then built around what is needed for the upcoming period, regardless of whether each budget is higher or lower than the previous one. Here we don't base on the historical figures. We always budget afresh. We start with zero, and we don't actually take the historical figures. We should understand what we call the master budget. The master budget is the summation of all the divisional budgets that is prepared by all divisions. It includes the financial planning, cash flow forecast, and budgeted profits and loss accounts and balance sheet of the organization. It is the goal of the organization to reach a level in a particular period. You may discover that in an organization, we have several sections, several departments, and each department has got departmental heads or managers. Therefore, the master budget will sum the totals, the subtotals of all those departments to come up with the master budget. Each departmental head with his subordinates will come up with a budget, and that budget will be known as a subtotal or a mini budget. So all those mean budgets summed or added together will actually result to what we call the master budget. Preparing a master budget, as hinted on above, a master budget is necessary for a business owner to determine all that is required to keep a company or organization running. Okay, several components go into a master budget. While the majority of items should be fixed, there may be some budgets that change as prices fluctuate. A caution for those fluctuations should be built into a master budget to ensure that the company has enough resources to cover any changes. When we talk of cushion, sometimes we give what we call a contingency in our organizations. Things may be what we have planned, or there could be a slight change. So that allowance is given in terms of percentage. Some organizations could put a 10%, some a 5%, depending on the experience. Now, on how to prepare a master budget, let's look at the next slides. Step one, add up all fixed budget costs. Step two, add up all flexible costs. These components are more unclear, but should have at least some idea of the budget constraints. Okay, the flexible costs like maybe fuel, refreshment, they may not be exact sometimes. There could be a change. We could limit the way people are consuming tea in the office, and the cost will be cut. We could also minimize travel expenses by saying, instead of using 4 vehicles with 4 people, let's use 1 vehicle, and all the 4 project officers can fit in that vehicle and the activities will run. So in a way, the cost will go down. And number 3, calculate your cushion for expenses to be at least 10% of your flexible totals, depending on type of industry or type of organization. I've told you before, some people go as low as 5%, depending on your experience. If you know that the variance, you're so much careful, you can reduce from 10% to 5% or 7%, but it all depends on your experience when you are actually putting cushion. Cushion, I've told you, is like a contingency. It's something that caters for emergencies, for eventualities that may occur, may not occur. Number 4, total or sum all the above figures, meaning fixed budget, flexible, then the contingency of 10%, add them together, okay? That's to say, we shall get actually a total figure. Then from that figure, we go number 5, we deduct or reduce any components if necessary to fit in the ability to make a profit or for the organization to be efficient. Okay, the master budget and budget formats. We are going to look at them in summary. Okay, so here we are, a formal summary of a company plans or organization. It sets specific targets for sales. It sets another target for production, then selling and administration, and capital acquisitions. All these are predetermined. They are predetermined and they are set before we actually get engaged into any kind of operation. It also culminates a budgeted income statement, balance sheet, and cash receipt and disbursement summary. All these are prepared, and the nearer they are to the actual figures, the more efficient an organization will be. If the variances are so big, then it's a sign of inefficiency or poor managers. Our selected budget format, we shall look at basically 6 of them: the sales budget, production budget, direct materials budget, direct labor budget, overhead budget, cash receipts, and disbursement budget. Of course, sales budget will handle sales, production budget will handle what we actually create so that it can be sold in the end for us to get money. Direct materials, what shall be used. This consumes not less than 50% in most organizations. Direct labor, this is what we transform the raw materials to finished goods that are sellable. Overheads, this could be direct expenses that are certainly the production of the kind of commodity or activity that we are going to put in place that will actually generate revenue for the organization. Cash receipts, what shall sell from our sales, or any source of income that we have, and disbursement budget, how this money will be spent. So number 6 is talking about what comes in and what goes out. Sales budget can be calculated, as you can see in our slide here. We get the projected sales units. This is the much we shall sell this number of units. Then you multiply them by the selling price per unit. You will get budgeted sales revenue. So if you are going to have 100 units and the price is 20, then multiply 100 by 20, you get 2,000 as the budgeted sales revenue. Our production budget, we get the budgeted sales units. We add desired ending inventory or the closing inventory stock of finished goods. We shall get total needs. After getting the total needs, we subtract the beginning inventory of finished goods. The result will be units to be produced. So this is the target we are looking at. So materials budget will be calculated as you can see on in our slide. Units to be produced multiplied by the cost of parts per unit. This will result into cost of parts needed for production. We add desired ending inventory of parts, okay, which will actually equal total needed minus beginning inventory of parts will result into cost of purchases. Direct labor will be actually calculated as follows. Direct labor hours per unit multiplied by the rate or labor rate per hour. It will result into direct labor costs per unit. Okay. Then multiplied by units to be produced, it will give us a total of direct labor costs. Let's look at overheads. How do we calculate them? Units to be produced multiplied by variable cost per unit, it will equal total variable overhead. Then we add the budgeted fixed overhead. We shall get total budgeted overhead. We less non-cash expenses. Like depreciation. The result will be cash disbursements for overheads. Okay, that's good. Lastly, let's look at cash receipts and disbursement. We get cash receipts minus cash disbursement. That's cash in, cash receipts, cash disbursement, cash paid. The balance will be excess or deficit or deficiency of cash available over disbursement. And we add the beginning cash balance. What we shall get is end cash balance. Cash in minus cash paid, add cash at the beginning, okay, minus cash at close, we shall get the ending cash balance. What is the static budget? This is a budget designed for only one level of activity. Okay, differences from the budget can be misleading when an organization actually operates at a different level of activity. So let's compare static budget and a flexible budget. The fundamental differences between static and flexible budgets are that a static budget does not change as volume changes, whereas a flexible budget changes line values to reflect the level of activity. A flexible one, in other words, is variable. Again, explained further, flexible budget is a budget designed to cover a range of activity, can be used to compare actual costs incurred to budgeted costs around that level of activity. Thanks for being a good listener. We have come to the end of our module 2, and here you have coursework to be done. Already you have done one accounting to 10% of the semester marks. Now this accounts for 30 marks, and it has 3 questions. Question 1 is what is the budget? You will earn 2 marks. Question 2, what are the functions of budget committee? You will earn 10 marks. Better you list and explain them. I explained the stages of budgeting. You will earn 18 marks. So this one is detailed. You give an example. Please send your coursework to the email briella.said@yahoo.com. You have 72 hours to complete this. Maybe as a reminder, for those of you who are doing international business, You have all the notes. I'm only giving you summaries. Then for this course of project cost management, I will give you more two modules to complete the whole syllabus so that we can be ready for the exam. However, part of the assessment is 40 marks, and you have already received 10. Now I'm giving you 30, which makes it 40. Then your actual participation will earn you 10 marks, and the final exam will earn you 50 marks, totaling to 100. So like this video, subscribe so that you can continue getting similar videos. Quite often, I send you some videos concerning proposal writing. They are not part of what will be examined, but they help you to understand the role of a project manager, because the role of a project manager, as I told you before, the role of a project manager is resource mobilization. So if you don't know how to write a proposal, you can never mobilize the resources of an organization. Therefore, as I teach the normal syllabus here, I should always coach you on how to write good proposals so that you can always be able to fundraise for your organization to ensure continued supply of money. Thanks again. Let's meet in the next lecture.